So, let's just dive right into it. Picture this. You're staring down a massive, heavy rulebook with exactly 470 sections. Literally, 470. If you're doing business in India, well, that's your reality. That's the Companies Act 2013. Now I know, it sounds incredibly intimidating, maybe even a little dry, right? But here's the secret. You absolutely do not need to memorize all 470 sections to get how the corporate world actually works. You just need the blueprint. And today, that's exactly what we're going to give you, the ultimate shortcut.
Welcome to The Explainer. I'm really excited you're here. Our goal today is super simple. We are demystifying the Companies Act 2013. We're going to take this totally dense, highly technical legal text and, just transform it into a logical, easy-to-grasp blueprint of corporate structure. By the time we're done, you're going to see exactly how all these puzzle pieces fit together.
All right, so here's our roadmap for today. We've chunked this massive list of legal jargon into 5 real-world themes. Number 1, meet the Companies Act. Then, exploring types of companies. After that, the people in charge, followed by corporate connections and control, and finally, following the financials. Let's jump right in.
Starting off with Section 1, Meet the Companies Act.
Think of this act as basically the ultimate operating manual for Indian businesses. It was put in place to really step up corporate governance, simplify regulations, and, this is crucial, protect investors. It's literally the absolute foundation of modern Indian corporate law. But what's actually kind of fascinating is who this rulebook does not strictly apply to. Like, while it covers almost every standard company you can think of, there are some major carve-outs. We're talking insurance companies, banking companies, and electricity companies. Why? Well, they have their own primary regulators. The Companies Act only really steps in for them if its rules don't clash with their specific industry laws. So while this act is totally sweeping, specialized industries still play by their own special rules first. Moving right along to Section 2, exploring types of companies.
Okay, so how does the law actually categorize the businesses that you and I interact with every single day? It really comes down to the most fundamental split in the corporate world, the private versus the public company. Now, on the private side, the name of the game is restriction. A private company legally restricts the right to transfer its shares. And here's the kicker. It caps its members at a strict maximum of 200, no more. But on the flip side, a public company is honestly defined by what it isn't. It's basically just a company that is not a private company. There's zero cap on members, which is exactly why it's the go-to vehicle for those massive, publicly traded enterprises.
But what about, say, the local mom-and-pop shops or those fast-growing startups? Well, the Act actually has a specific definition just to protect them. Calling something a small company isn't just casual business talk here. It is tied to hard statutory limits. To actually qualify, a company's paid-up share capital cannot cross 4 crore rupees, and its turnover has to stay under 40 crore rupees. If a private business stays snugly inside those exact numbers, it gets to enjoy way lighter regulatory burdens, which is a huge win for them.
Now, let's swing over to the complete other extreme. There's actually a super common misconception that a government company has to be, 100% state-owned. In reality, not at all. The legal requirement is simply that not less than 51% of the paid-up share capital is held by the central government, state governments, or some combo of the two. Literally, as soon as that 51% threshold is crossed, boom, the government holds the statutory reins. It's as simple as that.
All right, that brings us to Section 3, the people in charge.
At the end of the day, companies are really just legal fictions. They need actual flesh and blood human beings to breathe life into them. And the whole thing starts with the promoters. Now, don't get it twisted. A promoter isn't just some marketing cheerleader hyping up the business. Under this act, being a promoter carries serious legal weight. It's someone explicitly named in a prospectus or an annual return. Even more importantly, it's someone who actually controls the affairs of the company, whether that's directly or indirectly, or someone whose advice the board of directors is totally accustomed to acting on. They are the true behind-the-scenes architects of the whole operation.
So, once the company is officially incorporated and up and running, who's actually taking the wheel day to day? Well, the statute has a strict hierarchy for this, calling them Key Managerial Personnel, or KMP. Right at the top, you've got your Chief Executive Officer, the Managing Director, or the Manager. Then, just below them, you'll find the Company Secretary, the Whole-Time Director, and the Chief Financial Officer. These folks are essentially the legal captains of the corporate ship. They are the ones fully responsible for steering the business and making absolutely sure everything stays compliant.
Let's move on to Section 4, Corporate Connections and Control.
Okay, so how do different companies actually interact and, quite frankly, dictate terms to one another? The absolute most powerful relationship here is the holding and subsidiary dynamic. Let's break it down. Company A becomes the holding company of Company B if it controls the composition of Company B's board of directors, or, and this is a big or, if it controls more than 1/2 of the total voting power. Pass either one of those tests, and boom, you've got a holding-subsidiary relationship. It's total, unarguable control.
But hey, what if a company has a huge amount of influence over another one, but not, outright control? Well, that brings us to the associate company. This is an entity where another company holds what the law calls significant influence, but it isn't quite a full-blown subsidiary. So what exactly does significant influence mean in hard legal terms? 20%. That's the magic number. If you control at least 20% of the total voting power, but haven't hit that 50% needed for a subsidiary, legally speaking, you are an associate. It is a highly strategic, incredibly common middle ground in the corporate world.
And finally, we arrive at Section 5, following the financials.
Ultimately, a company's health, its honesty, its everyday actions, they are all strictly measured through some pretty complex financial rules. I mean, we always hear that every company has to keep books of account, but practically speaking, what does that actually mean? Well, the law dictates that these books have to capture very specific things. We're talking all sums of money received and expended, all sales and purchases, every single asset and liability, and for certain manufacturing companies, the exact items of cost. It is an exhaustive, legally mandated paper trail of quite literally every single rupee that enters or leaves the business.
Now, all of those daily books eventually roll right up into the official financial statement. And this statement legally requires 5 specific components. You need a balance sheet, a profit and loss account, a cash flow statement, a statement of changes in equity, and your explanatory notes. But there's a really fascinating exception buried in here. If you happen to be a one-person company, a small company, or a dormant company, the law actually cuts you a little slack. You might be completely exempted from having to provide that complex cash flow statement. Kind of nice, right?
As you dig a bit deeper into these financial statements, you're definitely going to see the term free reserves pop up. And listen, this isn't just, extra cash lying around in a bank account somewhere. The statutory definition here is incredibly precise. Free reserves are purely the reserves which, according to the latest audited balance sheet, are actually available for distribution as a dividend to the shareholders. It strictly cuts out any unrealized gains or notional gains you might get from revaluing assets. Basically, if you can't legally pay it out as a dividend to your shareholders, it is absolutely not a free reserve.
Speaking of paying people, how does a company legally reward its key players without completely draining its cash reserves? That is exactly where sweat equity shares come into play. These are equity shares issued to directors or employees either at a discount or for consideration other than cold, hard cash. Now, why would a company do that? Well, it's a reward for providing valuable know-how or intellectual property. It's honestly a brilliant statutory mechanism. It lets a company formally recognize and reward the actual sweat, the innovation, and the sheer brainpower that builds a company's real-world value.
So, after all of this, how do we actually measure the total underlying value of all this corporate structure and effort? That brings us to net worth. The math here is pretty straightforward. Net worth equals the aggregate of your paid-up share capital plus the reserves created out of profits. But, and this is an absolutely crucial point straight from our sources, it explicitly and strictly excludes any reserves created out of the revaluation of assets, write-backs of depreciation, and amalgamation. It's totally designed to be a super conservative, hard numbers measure of a company's true, realized financial strength.
And just like that, we've reached the end of our blueprint. The Companies Act of 2013 really is a massive piece of legislation, and it's purposefully designed to balance two competing forces, right? On one hand, it's trying to simplify the rules of doing business to promote economic growth, but on the other, it's rigorously protecting investors through these incredibly strict definitions and transparent reporting rules. But seeing all these rules laid out like this, it leaves us with a pretty provocative question to chew on. Does strict corporate regulation actually stifle business growth? Or is it the absolutely essential framework that builds unbreakable investor trust? Something to think about the next time you're scrolling through the business headlines. Thank you so much for joining me on this explainer, and hey, keep learning.